I think the education around both the REIT and the real estate funds are low right now. And I think as we get into a new cycle of real estate, which started a couple of years back, like I would say 2021, 22 is where when we have got into a new real estate cycle, which I believe would last there for next 5 to 7 years. I think a lot of investors should look at playing real estate cycle through that.
Hello, everyone. My name is Vikas Agrawal, and I am the founder and CEO of a company called AIF and PMS Express India. Well, we are emerging as one of the largest platforms for investing in alternate investments and portfolio management services. Why am I introducing myself is because I can see there are few investors who have just joined now in the previous session. So, at AIF and PMS Express India, we keep organizing these knowledge-based sessions, and the whole idea of doing so is to educate and empower the investor community as a whole. Thanks to our media partner, ET Markets, for giving us an opportunity to organize this session. Yesterday, we had about 10,000 investors attended the session live. So we're getting overwhelming support, and I take this opportunity to thank each one of you for giving us your patient hearing. With me, I have Mr. Sharad Mittal. Well, he doesn't need any sort of introduction. Most of you would know him. He is the founder and CEO of Arnya Real Estate Fund Advisors. And before starting up this company, he used to work as Chief Executive Officer and Chief Investment Officer of Motilal Oswal Real Estate Fund. He was the one who actually conceptualized the mezzanine investing thing at Motilal Oswal, spent there for almost a decade and taken the business from almost negligible or zero to close to $1 billion of assets that was raised under the able guidance of Mr. Sharad Mittal. And before that, he also worked with a couple of large organizations like ICICI and ASK, where he played an important role in terms of working closely with some of the high quality developers in India and able to create a very good structure out of it. So, Sharad, first of all, thank you so much for accepting our request and taking the time out from your busy schedule.
Vikas, it is so good to see you. Vikas and me being ex-colleagues. We used to both work at Motilal Oswal. And let me first congratulate you and your team, because I've been seeing the kind of audience you are getting. And I think it's very timely. And I really thank you and your team to invite me for this. In the whole today, real estate would also find its space as an asset class, and we'll be able to explain some of the things that is happening in real estate. But congratulations on such a great event.
Thank you, Sharad. This is the first session that we are doing now on real estate, and the idea was that we thought who would be better than you to talk about this and simplify the whole thing for the betterment of our investors. So without any further ado, I hand it over to you, Sharad. If you can give us a brief introduction about your organization first, and then we'll come to the offering that you're talking about.
Sure. Thank you. And thank you everyone who has joined for this session. A quick background about me. I've been in real estate investing business for the last 23 years now. Of that, last 17 years have been with private equity firms. Like Vikas mentioned, last 10 odd years were with Motilal Oswal. They had given me a great opportunity to build a real estate private equity platform from scratch. And over the period of last decade, we built a really successful and large practice. I moved out of Motilal Oswal in the month of October last year. So it's been 6-7 months that we have gone independent. And the idea here is to build an independent real estate investing platform, private equity platform. We have launched our first fund in the month of March and currently on the road to raise the capital. The mandate of our first fund is a debt. And that's where we have done fair bit of transactions at size and scale during Motilal Oswal tenure. Prior to Motilal Oswal, I have largely worked with ICICI or ICICI group companies, started with retail mortgages and then going up to private equity funds in ICICI Pru. Real estate is a subject very close to my heart. This is the only thing that I have done all my life. I've also been fortunate, or in a way unfortunate at times, to see multiple cycles of boom bust in real estate, beginning from 2001 to to GFC of 2007-8, and a really troubled cycle between 2012 and 20, a really prolonged cycle. And we are hoping as a team, we would be able to add value to our investors, given our experience in this sector.
Yeah, sure. So today's topic is basically, want to read your mind, Sharad, is how NRIs particularly can take the benefit of, because you also have offering which is listed in Gift City. So if you can simplify the whole investing journey for NRIs to be able to take the benefit of real estate appreciation in India while investing through AIFs.
Yeah. So because today's topic is how NRI investments can invest into real estate through AIF route. Now, before we get into in that, and I'll explain it in detail and how this can work very well for them, I would like to take 5 minutes and first give a perspective on how the investing into real estate over a period of last 15 odd years is changing. And I will draw parallels of it with equity markets and some of the other asset classes and how this has evolved. And then we probably will take up on how NRIs more specifically can look at. If you see historically, real estate investments till 15 years back also, till 12, 15 years back also, has always been investing into physical real estate. Most of the domestic investors or NRI, if they have to take a real estate exposure, their go-to investing thesis will be to go and buy something in their neighborhood or go and buy in their city that they're living, and they will end up buying apartments and would have seen various kind of returns. The rental returns will be 2.5%, and a capital appreciation would be between 8 to 10%. Or some of them who have more means or know-how will probably go and buy a commercial property and like to have a rental income on it. And then there are investors who are far more informed and far larger capital will probably end up investing into physical land and then will make returns through that. This has been the traditional way of investing ever since I remember. And it has done really well for investors over a long period of time. The things started changing around 12, 14 years back. So right now, when investors look at physical real estate as the sole way of looking at investing, there has been a financial real estate investing also, which has grown over a period of last 12 to 15 years in India. What has happened in equity markets, what has happened in the other asset classes, the real estate financial investments at a nascent stage. For example, I remember I used to do my industrial training way back in 96, 97 in Citibank, and the mutual fund had just started in 95. It looked like a very different animal. I remember somebody was explaining to me in Citibank, look, this is a new way of investing. And they explained it is going at a premium and things like that. And it took almost 12, 14 years for people, for investors to really understand the power of mutual fund. And look what has happened in the last 8, 10 years. It has also happened because there is a regulatory framework. It has also happened because there has been a lot of education that has happened. It has also happened because the investors have seen good returns on these asset class. I think real estate is going through the 95 to 2000 time, similar time, what has the capital markets have seen. Investors right now, not only they can participate through physical real estate, but through financial real estate. Financial real estate can be done by two ways. First is the AIFs, wherein money is pooled in by manager like us, invested into residential or commercial property. This can be done as a debt, this can be done as equity, or this can be done as a balanced, which is a mix of debt and equity. There are several funds which are there in the market, wherein they play the whole real estate cycle by doing an AIF, where the minimum ticket size is 1 crore rupees. And they create a portfolio just like portfolio is created by mutual fund or AIF manager. Here the ticket size is larger, but there is one more asset class, which is a REIT. Right now, we have 4 REITs which are listed into India, where the investment amount is significantly lower at 50,000 rupees. And I believe over a period of time, it will go down to the level of mutual fund. First REIT came in 2018. And in 5-6 years, we have now 4 REITs in place. What is a REIT? REIT is a vehicle which can give you regular rental income and an appreciation coming out of the property. So the core objective of anyone looking to invest into real estate is to make appreciation through the residential appreciation, commercial properties, or want to have a rental income. All of it can get achieved by investing into various funds which are there in the market. I think the education around both the REIT and the real estate funds are low right now. And I think as we get into a new cycle of real estate, which started a couple of years back, like I would say 2021-22 is where when we have got into a new real estate cycle, which I believe would last there for next 5 to 7 years. I think a lot of investors should look at playing real estate cycle through that. How can NRIs participate into it? And I think one of the things which used to struggle as a fund manager whenever we used to go and out try to raise capital outside is the clarity on the regulation, the clarity on the taxation. All of you would have heard about Mauritius, Singapore, Cyprus, and vehicles getting formed there, money getting pooled in those geographies. And the primary motivation of pooling in money in these geographies was tax advantage. Because there were they're effectively called tax havens for those reasons. I think over a period of last 5 years, the current government has done an excellent job on GIFT City. Effectively, now we as a manager really don't have to go out and pool money in any of these jurisdictions. Money can get pooled into the GIFT City. And because it's an initiative by the Government of India and Ministry of Finance, the rules and regulations are absolutely clear. There is no ambiguity. So when the investors are putting in money, there are no ambiguities around how the processes, how the taxations will work. Let me simplify it. If a NRI wants to invest money into Indian real estate through private equity funds or to a REIT, they can invest into vehicles which are formed in GIFT City. For example, we have a GIFT City vehicle and we also have a SEBI license in India. So Indian investors puts in money into the domestic AIF, and the NRI investor or foreign nationals are going to invest into the GIFT City where we pool in money. How does it work for those investors is they need a clarity on if they're going to invest into GIFT City, what will be the taxation, what will be the fee structure, and how easily they can get their money back. Because repatriating money back to their own country is one of the key objectives they have, that if they're investing in India, they don't want to get locked in. All these things have been addressed through the new regulations which have come in the GIFT City. First of all, the NRI investors who puts in money into the GIFT City vehicle, the fee charged to them, they does not have any GST on it because it is invested into foreign jurisdiction, because from an SEZ perspective, so there is no GST. Wherein a domestic investor, when putting into money into domestic funds, will end up paying 18% GST. So this is first saving that happens, which is around the indirect tax. All kind of fees are exempt from the GST. The second thing, when they're investing into real estate fund, which can give them two kind of income. One is interest income, other is the capital gain. Then there are various categories of fund in GIFT City. I'm taking an example of category 3, and then we'll take an example of category 2. So in a category 3 fund, which is a non-pass-through fund, the fund will pay taxes. For example, if the investors are coming, the taxation is dependent on which jurisdiction they are coming from. For example, they are coming in from Middle East. The Middle East does not have any taxation. So then it is referred to the double taxation treaty between India and Middle East. In that case, in India, in GIFT City, we have to pay only 10% tax on the interest income and nil taxation on capital gain. In category 3 fund, the fund will pay it and remit the balance money to the investors there. They don't have to do any filing in India. They don't have to provide a TRC as well. Specifically for Middle Eastern investor, the category 3 fund is excellent because effectively they are not paying any indirect tax in form of GST, and the incomes that they earn in form of interest income and capital gain, the tax is paid by the fund, category 3 fund manager, and the balance money is remitted. They don't have to go through any administrative thing as well. Additionally, for fund managers like us, there is a benefit that we have a 10-year tax holiday in our income. That makes it very attractive that the government has put in tax SOPs, both on an indirect and direct side, to attract capital from outside India. Now look at beyond, say, jurisdiction of Middle East, GCC countries, say Singapore or a London, UK or a US. From there, the money should be best pooled into category 2 fund.
Category 2, not 3.
Yeah, I hope it doesn't get too technical, but I'll try to simplify.
No,
There is
category
category
2
3
is well simplified. Category 3, you're
Yes.
saying that.
Now, what happens is in these countries, there is taxation which is there. In GCC, say Bahrain, Dubai, Oman, there is no taxation there. So category 3 is useful. Fund can pay the tax, remit the balance money to them. They don't have to do TRCs and filing. But if somebody is coming from Singapore, Singapore has taxation, both on interest income and capital gain. There is a taxation there. So then we have to refer to the double taxation treaty. India has double taxation treaty with most of the large relevant countries. So India, Singapore has a treaty in which the same money is pooled into category 2. Now, when the money is sent out to Gift City, there we deduct a TDS of 10%. And the balance money we will send out to investor in Singapore. Under the treaty, if I remember it right, on the interest income, there is 17.5% tax. They will get the credit for the 10% TDS which has been withheld here, and they have to pay only 7.5%. So, like, we have to see country by country. Outside of GCC, the best vehicle is category 2 in Gift City. For GCC, it is category 3. And the way the whole tax advantages have been put on the table, both for the manager and the investor, and the real estate cycle that we are in, and to play the Indian real estate in the best possible way, whether it is the appreciation of residential property, to have debt returns, or to have rental income. And at a ticket size, today, if you ask any investor, a lot of investors speak to me that we want to buy apartment and because there will be an upside. आप ये मुझे बताइए, बॉम्बे एंड दिल्ली के इन्वेस्टर 1 करोड़ रुपए में क्या खरीद सकते हैं? Hardly anything that will come in 1 crore rupees. And then you are also expecting property prices to appreciate to get the upside on it. Wherein if that same 1 crore rupees is invested into a fund, the fund will end up doing 20 plus investments and will do across this country. So one will be able to have a diversified portfolio across India in a 1 crore, which will give them either as a debt return or equity return. They're able to reach to their objective. The challenge here is that, again, the timing, education part of it. People look at real estate more like lock-in key. Beyond your own one house, or maybe one more house for the family for the future, everything else is investment. But this thing of having lock-in key, going there, and wanting, because real estate is like cricket. Everybody is an expert in their neighborhood. They know what property is launching, but if the objective is to make return, the best is to create diversified portfolio. I would also make a case for REIT. I'll give a simple example. Say if somebody is living in Bombay and you cross BKC every day and you say, wow, what fantastic buildings are coming. Or I'll give you an example of Delhi also. You cross Saket every day and you say, see a mall, select City Walk. So the one is a mall, other is an office in BKC. And then you say, yeah, I think both of them will do well over a period of time. I wish I can buy these properties because rentals will go up, India will grow, spending will grow. Is there a possibility? It's not possible to own these assets by very large investors also, because the ticket sizes are in couple of $1 billion. But if the same asset gets listed on the stock market, only the asset gets listed on the stock market, and one can become a part owner in that by investing 50,000 rupees. And whatever rental comes on it is passed on to the investor. So I can become a part owner in Select City Walk. I'm just giving an example. By putting in as low as 50,000 rupees and can get regular rental income and an appreciation on that. This is something which happened for the first time in US in 1962. This happened for the first time in India in 2017. So what I'm saying is the power of financial product to play the various part of investment portfolio. I think real estate has come late to the party. It is 20-25 years late to some of the other asset classes, but this is something that one investor should not miss.
So my next question is, you talked about the taxation aspect, but what is the kind of indicative yield investors, especially the NRI investors, can make?
So Vikas, like I said, just like in mutual funds and PMS, you have funds with various strategies. They can be fund which are doing debt strategies. There are fund who will do equity strategies. By and large, debt is the strategy which is most preferred. Typically, what we have seen, and this is the basis of our last 10-year track record at Motilal Oswal when I was there, typically a gross return of 20% in rupee terms is something which we believe is something which can be generated, uh, which after fees and expenses and bit of a currency loss and taxation, I believe 12 to 13% dollar return, assuming a 2% depreciation on the rupee, is something investors should expect unlevered. On the debt side, there are not too many equity funds which are there who have really tapped into the NRI. There are some global funds which have been doing. So I would say an investor in dollar terms can expect between 12 to 15% return depending on debt or equity it is.
Okay. So can you compare that returns with other global markets, the real estate, apple to apple comparison?
Look, real estate in last 2 years, we know that the yields have gone up across the board. When we look at US yields, they have moved up from 0.5 to almost 4.5%. So I would say if one look at only purely on yield basis, real estate returns in some of these markets are extremely healthy, specifically US. But there are risks also. See, the yields have moved up. If you look at commercial real estate in US, in Manhattan, the vacancies are 30%. People are just not coming back to work. People would have seen those newspaper article, property price sold at 70% discount. It is happening because people are just not coming back to work. Wherein in India, we have been lucky that we skipped the entire work from home culture. And I would say by and large, people are back at work. So some of these markets where the distress around some of these asset classes can generate good returns, but you run a risk of they continuing having large vacancies and the culture of work from home to there to stay. But I would say if you look at India, not only from a return, but the opportunity and the growth perspective, a 12 to 15% dollar return will stack up excellent in the global portfolio.
So you run
See,
cat to a
because,
cat.
because what I keep saying is, uh, when I meet a lot of investors in the fundraising, and in the past, we have generated in rupee terms 15-16% return. Andhi Tufan of equity market makes 15-16% return look very low. But everything has to be seen in the context of risk adjusted return. If you are doing debt, collateralized, regular coupons, and in an upcycle of real estate market, same way, if we compare the global returns, it has to be seen of how India's decade is looking like. And in that, I would say a 12 to $14 unlevered will stack up very well.
Okay. So you run for NRIs, you have cat 2 or cat 3, Sharad, at your
We,
system?
we have category 3 license right now, and we will be taking category 2 license as well.
Okay. So the people from Middle East Asia, they can
We are
continue
in a
to.
process. We are in a process of taking category 2 license as well, because we expect some of investors to come from Singapore and UK as well.
Okay. So, okay. So that becomes tax efficient also for them.
Yes, because category 3 is not the vehicle outside the GCC.
Okay. The other thing is you said that they got to get returns in two components. So one is the interest income, the other one is capital appreciation. Can you give us the breakup of the same?
See what happens, Vikas, is that we are looking to do direct transaction to generate an absolute return of 18 to 20%. We come at a stage of a project wherein you can't really pull out the entire money from the day one as 20% coupon. So we split into two parts. Say half of it is interest, which is paid regularly, and balance comes along with redemption premium after 2.5, 3 years. That can come either as the interest, or if it is eligible for capital gain, it will come as a capital gain. So the funds have a certain life. The average maturity is 3.5 to 4 years. We draw the money over a period of 18 to 24 months. Money is not taken together. The whole idea is to create a portfolio which is constructed over a period of time. So you have diversification. And from each investment, say 6 months from each investment, a regular coupon is paid out, which is taken from the companies in which we have invested. And when the debenture gets redeemed typically after 2.5, 3 years, a form of capital gain or interest income comes at that point of time. The balance return.
So initial 2 years for drawdown, then you have 3 years of tenure, and then
Yes, and then we return the capital.
you start returning it, and the
तो
return
पहले 2 साल drawdown, last के 2.5 साल capital repayment, बीच में money is invested fully, and regular interest is paid, and whenever the exits happen, we pay capital gain or the balance return in form of interest.
Yeah, and for domestic or NRIs, the yield is going to be same around, right?
It is identical fund. The money which is pooled into GIFT City is invested into domestic fund. They are invested together. Only thing is that there the returns are calculated in dollar terms because we need to return the money in dollar terms, not in rupee terms.
Yeah, and if rupee may get strengthened, then probably
strengthen to I'm not really sure whether, but I think given the gap in inflation now, which has significantly reduced between India and US, and some of the overhang on US currency, we might not hopefully depreciate at the same pace at which we have been doing for last 20 years.
Yeah. Sharad, I also want to read your mind out there because you're part of various bodies also and keep representing many things on the real estate side. Is that at the GIFT City level, what is the kind of inflow that you think as an industry we are witnessing, and how has been your journey and experience so far?
So Vikas, like I said, real estate, financial real estate, if I take out the large global investors who have been investing into India's commercial real estate, the allocation towards real estate funds per se, I would like to talk about, not about REIT and some of the global funds which have invested into commercial real estate. The allocation towards the residential real estate through private equity funds have been very low. I'll give you some number, Vikas, and that's where I believe next 10 years, with the education around these products and the performance that will come because of managers on market, if you really see collectively in India, which is such a large market where wealth is growing, collectively all real estate put together on an annual basis last year would have raised 4,000-5,000 crore rupees. All fund managers put together. I'm not going to compare it to equity markets where there are large breakout, and I think that number will be in a couple of lakh. But if I compare it to some of the other asset classes, whether it is private credit or say venture capital, I think real estate allocation from the investors and advisors have been very low. I believe over a period of time, the similar number will get reflected in the GIFT City as well. This also could be possible that we had a really long 2012 to 28 years of down cycle. So a lot of investors wouldn't have had a good experience of investing into real estate or real estate fund. And only the cycle has turned in last 2 years. But I would like to say one thing to all the investors and advisors. Real estate is a cyclical business. You have to play the cycles. And historically, if you look at real estate, it has given returns to investors. Typically, a physical real estate like an apartment has given a return of 12% over a 40-year period. Lands, of course, can give a multi-bagger return. But I think there has been a recency effect between 2012-20, which is playing out, with last 2 years doing well. And some of the managers knew, like we have come out in the market with a newer product. I believe next 3 to 5 years looks good from a real estate fund industry as well.
I have no doubt in my mind that under your able guidance, Sharad, Arnya Real Estate would be able to raise $1 billion under GIFT City.
Thank you so much. We'll try our best.
Yeah. Thank you. So with that, we'll conclude the session here. Thank you. It was a pleasure speaking with you, Sharad, and truly appreciate
you so much. Wish you all the best, Vikas. You're doing a great job. Thank you.
Thank you.